Hi, I'm Chloe Carruthers here with Barry Norris, the fund manager of the Argonaut Absolute Return Fund, here for our April update. Barry, it was another tumultuous month for markets. How did the fund perform, and what were the main drivers of performance?
Well, Chloe, the fund rose over 6% in April, and that compared to a market which was down a lot and a peer group that was essentially flat. The correlation to the market was low at 0.27, and that's despite a long to short ratio of the fund of approximately 2-1. So I think that really illustrates the diversifying nature of the fund's return profile. Our winners were generally in the short book. What helped us was that the dead cat bounce in profitless growth companies that we saw in the second half of March reversed engines. Our biggest winner was US online car sale company Carvana, which collapsed 40% following a poor trading statement and worries about whether it would be able to finance an acquisition of a peer, Odessa. And German property company Adler also fell nearly 40% following the publication of a damning KPMG special audit, which its chairman had previously claimed had absolved it of all wrongdoing. On the long side, we've made money from K&S, which rose 17%, which is a German potash fertilizer company, and also an oil tanker company, Euronav, that we're long of, also rose 15% when it was bid for by peer Frontline.
You had previously written to the German financial regulator BAFIN and went on public record that Adler had misled shareholders about previous transactions. Is this ESG with an Argonaut spin?
Well, Chloe, we've always believed that good corporate governance is essential for investing and the function of good capital markets. And I think there's more than one way to achieve this. So the mainstream ESG world has been very focused on working with companies, helping them tick boxes. But frankly, that's never going to work with the real market abusers who set out to steal from shareholders. Adler, for example, had very high ESG ratings. So one wonders what was the criteria involved and how rigorous that analysis was. So to our mind, the best way to hold corrupt management to account is through activist short selling, which eventually denies management capital and cleans up the stock market. So I think Adler is yet another example of Argonaut punching above its weight in terms of good corporate governance.
There was a substantial increase in hawkish rhetoric from the Federal Reserve during the month. What did you make of this, and what are the implications for financial markets?
Yes, Chloe. So I think really important. So Fed Chairman Powell talked about moving more quickly to restore price stability and suggested that monetary tightening would be more front-end loaded. So hoping, I think, that a series of 50 basis point rate hikes now would avoid higher rates over the long term. This will, I think, exacerbate liquidity risks in financial markets and cause a slowdown in the global economy. So it's difficult to avoid the conclusion that this is a short-term incremental negative for all financial markets and positive only for the US dollar.
Can commodities still perform into a front-loaded Fed hiking cycle?
Well, that's a very good question, Chloe, and obviously key to the way that Argonaut portfolios are positioned. I think against what's going on with the Fed, we have to consider what's going on in China, where cities are still subject to COVID restrictions on terms of lockdowns. And I think, as we know, COVID usually goes away over the Northern Hemisphere summer. So I'd expect there to be greater demand for transportation fuels in China over the summer. And I think the Chinese economy should start stimulating, or at least that's the noises that have been coming out of China. So that will provide, if you like, some counterweight to what's going on in the US. And then we need to look at really what's been going on in terms of the Russian-Ukraine crisis. So the noises coming out of the EU is that Russian energy will be banned by the end of the year. That obviously means that Europe will have to replace Russian oil, gas, and coal. And of course, the global economy will have to replace the agricultural commodities that usually come out of Ukraine and Russia. So all of that is going to be very positive still for commodities. But I think it would be naive to think that demand or global demand for really anything won't be affected by the Fed tightening cycle. But at the same time, just viewing commodity prices through the prism of aggregate demand, I think, is also a mistake. So I think there are other dominoes which will fall in this tightening cycle before commodities. And I think this means that actually killing inflation and bringing it back under control will be more difficult and dangerous in terms of collateral damage than perhaps what there will eventually be political appetite for.
Will a front-loaded Fed policy put us back into a deflationary environment that rewards long-duration assets?
Again, another good question. I think potentially, but I think it's now too early for that. And I suspect if it did happen in the future, it wouldn't last for very long. And I think, remember, unlike commodities, long duration assets have received a lot of capital over the last decade, and there's a lot of competition. So if the Fed actually achieves the hard landing necessary to bring inflation under control, then it will need to presumably reflate again with the same global supply constraints. So front-loaded interest rate hikes may actually, ironically, make long-term inflation worse if it discourages capital formation in these old economy industries necessary to resolve supply chain bottlenecks and mitigate deglobalization. So the concern is these stop-go cycles. So a front-loaded policy response could actually have the reverse effect and result in higher inflation over the long term. So in our minds, the only long-term solution to inflation is actually a sustainable bull market in commodities, which results in commodity companies actually investing to bring new capacity and new supply. And this will inevitably take a number of years. And so that's why, although we think there might be some bumps in the road, that commodities still remain the most compelling investment opportunity over the next decade.
You added to reopening plays during the month. Why was this?
Yeah, so we increased our exposure to reopening plays in the travel and leisure industries. I think it's become clear that cabin fever amongst consumers who have been locked down for a few years will see the redirection of discretionary spend, and that travel companies currently have unusually high pricing power. So although these conditions may prove unsustainable, I think our positions in reopening plays provide a natural hedge to our energy-related longs.
You updated your research on the usefulness of wind power during the month. What did you find?
Well, we analysed last year's power prices and found that although on average power prices were high, there were in fact 13 days when the power price was incredibly low at £20 per megawatt hour, and in fact 2 days when the power price was negative. So what did all those days have in common? Well, frankly, the wind blew. And because the wind blew, the share of wind power was at least 45% of all power generated. So I think what that tells you is in the UK, when the weather's favourable, we already have cheap power, but when it's not, we have an energy crisis. So what's the point of adding more wind power? So our conclusion is that wind has already peaked in terms of its optimal market share of power generation. So although there's scope to add more nuclear over time, particularly using more modern technology, the fact is that it will be incredibly difficult, if not impossible, to replace gas as the most reliable source of baseload power, which can be switched on and off when the weather isn't favourable for wind and solar. And I think we also have to remember that the UK has already halved its carbon emissions and is now less than 1% of total global carbon emissions. And that was achieved through switching coal off and replacing it with gas. So I think going back to ESG, it's too simple for fund managers to claim that they are supporting the environment by allocating capital to renewables. And when this has no economic value, we must also think, well, it does have damaging, it is damaging to the environment in that it has a negative impact in terms of resources. It has a negative impact on wildlife. It's unsightly, and wind turbines, when they're finished, they need to be disposed of. So I think that the problem is that the consensual ESG wallet just doesn't want to engage with this problem.
What would you say the fund offers investors, which most other equity funds do not?
Well, the fund's now up 18% year to date and up 69% over 3 years, with almost no correlation or market beta. So that in itself is a pretty unique and valuable return profile, which is different from most other funds, which requires the market to go up. Since October last year, we've been warning about the dangers of a 1970s redux and suggesting that we're in a market where commodities are going to do well and other asset classes and most equities are going to do badly. So I think you don't have to agree with us that the 70s redux is something you might want to hedge against. And therefore, I think that the fund provides a really valuable return profile compared to other strategies which are more dependent on market direction.
Great. Thanks very much, Barry.
Thank you, Chloe.